Okay, Mark Anderson here, construction worker turned zero DG hedge fund manager. We're back with Connor. We've got some updates. So, little preface for this week. We're going to let basically Connor's 4 or 5 trades roll basically through the end of the year, and then we'll dive back into results and any tweaks. So this will kind of be a little more Q&A of what Connor's been looking at as he's been learning more options, and we will also look more into detail, maybe with some hands-on back tests and such. So how's it going, Connor? I know you have some questions or things you've been going on.
Yeah.
So if you kind of want to give people an update of what you've been looking at or some specific things that you would kind of like to cover today.
Yeah, so just to give everyone some background of what I'm going to be asking, I've been doing some trainings, and one of the training was on short strangles, and it piqued a lot of my interest because it reminded me a lot of calendar trades, and I saw a lot of similarities in that. And when he was talking about in the training the short strangles, he was referencing out of the money a lot, so I kind of just assumed that he was running with Delta and not premium. And so when he did pull it up, he pulled it up in sink or swim. So like I honestly, I can't read sink or swim how he's putting it in there. I'm just familiar with options omega. So instead of using his numbers, I was just like, let me just try to make my own trade basically.
So let's go and if you want to share your screen and pull up what you have in options omega.
Let me do that.
And also kind of like, what is a strangle, if you want to describe it to me, and how is this differed from what we're trading?
To be honest with you, I'm going to try my best on that because that was going to be one of my biggest questions because I was putting
let's go line by line. So let's start with the legs. Explain to me what you're looking at here with the legs. What exactly are you kind of doing? Are you buying? Are you selling? Where do you think the risk is?
Yeah, so on a basic level, can you see my screen, by the way?
Yeah.
On a basic level, I'm selling a put and I'm selling a call, and I'm both selling them. This one's out of the money, and this is out of the money as well.
Mm-hmm. Okay, and then you have a delta. What delta is that, and what probability do you think that is?
So it's a 30 delta, so 30% chance that it's going to fall within the money.
Okay, and then your days to expiration.
The days I did. So I know this kind of probably looks random, but it was 2 days to expiration, 0 days to expiration. I saw that we staggered them on one training, and it was for example, it started at 30, and I wanted us, we trade zero DT, so I was trying to keep it close to that, and I just tried to bring it down to where I saw like it was just getting the numbers that I liked, and that's just where I landed on it. Yeah. I think if I put 2 and 2, it blew up the max drawdown a lot. So when I went 2-0, it brought down the max drawdown.
So few things here is when we're doing these, we're usually not going to want to have different duration. So
makes sense.
Basically, when you think of it as like, what is a vertical spread? A vertical is we're selling and then we're buying an option basically below it to cap our buying power. And then when we are in the 0 day expiration, so you have a stop loss here.
Yep.
So if you click trade log and then go to filter all and then click losers. And then there. Okay. So when you see here with our stop losses, when we are going longer than 0 days in duration, we have not even a remote guarantee if our stop loss is going to be at that 100% loss, because the market does not trade between 4 p.m. and 9:30 a.m. So if you scroll back up to the top, SPX, we're using SPX, which is a massive instrument. Do you know how big SPX is?
No.
Okay, so SPX is 100 times larger than its points. So SPX is roughly 6,000 right now. So 100 times larger than 6,000 would be how big of an instrument?
Math is hard, but that would be 600,000 or 6 million.
600,000. So clearly, with a 30 grand account, like we could not mess with overnight risk unless it's calendar.
Yeah.
So that's the first problem with using overnight stuff. And then, like when we're running this, let's say, well, you did it on Monday and Friday, so that would be fine. But if we ran this Monday, Tuesday, Wednesday, Thursday, Friday, we would have like 3 times the amount of contracts on the put side than the call side. So we'd also be taking a massive risk. So if you want to go to new back test, an example I can give you is you can type in, go to ticker and change it to SPY. So now we're only trading to 50 grand underlying, which is better. And then change the days to expiration to 7.
On both?
Yeah. And then let's change the put to a 15 and let's change the call to a 5, let's say. And then run it. Actually, and then cancel test. And then scroll down and do it daily or something.
All right. So you're explaining that with its, so
now
you want it to be in SPY as well. Can you explain
so
that? Why?
SPY is again 100 times the price, but SPY is 500. It's 1/10 the size of SPX. So we could maybe potentially run this in SPY. Now run it.
I see what you're saying.
So basically, we don't like to use SPY and 0DT because the commissions to get in and out like screw us because it's so much smaller. And then it could potentially, we could get assigned. So SPX, everything just finishes off the cash where you could get assigned the shares in SPY. Okay, so this does not look very good. But basically, this is why we trade 0DT and something we don't really like to do. And strangles, look kind of difficult in general. And this is basically all from massive overnight moves. So if we're going longer than like, 1 day, or maybe another example is like, you could maybe do this on a 1 day, but then our gap risk of overnight is going to really screw us. So if we maybe go back to a new back test, and I kind of want to show you this concept. Now change them to 0DT on both.
This makes sense too. To defend your point, Mark, I had to bump it up to 100 grand before it even worked because I think I was stopping out so much on a 30 that it won't even run.
Yeah. So with 0DT, the thing I want to show you now click the paperclip on one of them and then go to buy and then go to the plus or minus and then just go minus 100. And then do the same on the call. And buy it. And then run it real quick. Okay, so the thing I want to show you here is this is what's called a synthetic strangle. So this is why we trade 0DT. So when we were looking at that trade log, go to trade log. You only have 4 trades, but that's okay. You see how we're paying 5 cents or 10 cents for the buy to open, the green part? Oops. There. Yeah, you say we're paying 5, 10, or 10 cents for whatever. So this is basically what is called synthetic. So we basically get all of the benefits of trading a strangle, except we only pay 5 or 10 cents to cap our buying power. So we're 100% certain of what our absolute max risk is. We can continue to play another day and we can make more occurrences.
Makes sense.
So this is basically the whole reason why we trade 0DT is it's cheap to trade strangles because we're just paying 10 or 15 bucks to basically cap our buying power. And with your size account, it's very valuable to be able to, define definitely what our worst case scenario is. So now when you're kind of thinking of it, the best way to do it is basically like think of the fact that when we're trading 0DT, we are trading strangles. It's just synthetic. And kind of after that, I'd ask you if you could reiterate why do we trade strangles in 0DT and what's the difference between a strangle in 0DT versus longer duration?
So a reason why we trade the strangle in 0DT is basically you're saying because we can, when we do it in 0DT, we can do it for cheaper.
And when I say cheaper, what do you mean?
To buy the premium that we're buying to get in. Is that correct?
So it's going to be cheaper in the fact that if we're 100 wide, how much buying power does that use?
For 100 wide, that for this exact credit that I'm looking at right here, that's going to be $100. That's going to be $18.
Yeah,
Right.
so that's the money we collected, but how much buying power or basically like margin do we have to use for that? So buying power is the width of the spread in between the long option and the short option. So for
Yep.
100 wide, how much buying power does that use?
For the 18, that would be. I'm trying to think because I get confused sometimes. It's because you're just timesing that by 100, right?
Yes.
So
But
that would
that's
be
the premium you
$18
collect.
of buying
So
power, right?
yeah, so we got two parts to it. If we trade 100 wide spread, we have 10 times that's $10,000. That's our worst case. Obviously, we're using a stop loss, so that's not the worst case, but that's what the broker wants us to put up as collateral for the right to collect that $18 in credit.
Mm,
Whereas if
interesting.
we were naked, which means just the selling ones, do you understand what naked needs to, like your original
Yeah, where we
strangle was
don't
naked?
have this here to protect us,
Yeah.
basically, the buying power.
So if we did this, if you want to run this at 7 days out or 3 days out, you'll see we're paying significantly more for the long leg now, you know?
Oh, all
And
right. That
the
makes
other
sense.
the other problem with that too is that when we pay that much for the long leg, all of a sudden, like not only are we using way more buying power, but all of our positions start to be like way more correlated. So look how much you're paying for the long leg now.
Yeah.
Scroll down. Yeah, you're paying more.
Yeah.
So
Oh, 40
this is
cents
not,
more.
yeah, this is not really something we would want to do. So one thing I will kind of send you to do next time is run this on 0DT and find a synthetic strangle that looks good. I would
Right.
encourage you for this one, let's use a profit take and a stop loss, and we'll manage
Mm.
the entire spread. Also, another piece of advice of what would be good is let's either focus on the last 2 hours of the day, which is what time?
Four. So that 2 to 4 spot,
Yep. Or let's focus on the first 2 hours of the day, which would be what time?
like 9:32 to 11:32.
Yep. And let's experiment between 50 to 100 wide.
Mm.
And let's, like, again, use that profit take or stop loss and see basically what we can find. And let's target premium instead of delta. And a little advice too is I know we've talked about put skew. Do you know what put skew is?
I can't remember it honestly.
So
Oh, is where it's yeah, put scoot. So it'd be like a $2 and $1, right?
yeah, so we're going to get paid more to take risk on the put side than on the call side
Makes
because
sense.
people are more afraid of it going down. And this is
Yeah,
just kind of how the index basically is used.
that makes perfect sense. So that's why you skewed it. I never. That makes sense. I never really realized that's why you're all. I mean, I thought we skewed it just because that's why the back test when we run all those numbers, that's why it came out. But the theory behind it is that makes
Yeah.
sense.
So the best way to kind of do this is like mechanics wise, our entry, let's try to do it every day. And the reason we want to do it every day is because if you're able to find edge and you're able to create more occurrences, that edge gets indefinitely bigger over time. So you're basically, even though it doesn't look good on one day, if we can make sure that is accurate to our backtest over 200 days, it's going to look really good for our like miscellaneous parameters. If you get a new backtest, scroll down to the bottom. Or, okay, so to your stop loss, scroll up. So these are going to be some settings we want to have. Scroll up a little more. That's slippage, stop loss slippage. So stop loss, you're going to use intermittent stops, right?
Oh yeah, I
Yep.
meant to put that one
So you're
on
going
there.
to use
Yep.
that. Make sure you use that and then scroll down to the bottom. What else do you think you want to click in this below the slippage category? So entry and exit slippage, how much are we going to put in? We talked about a percent here.
Don't we always put like around that $2 mark for the exit and like
2% for entry, 5% for stop loss. And then
makes
the
sense.
thing we're actually going to change here is you're going to hit, if we're using a profit take, which we will in this trade, you're going to hit require 2 consecutives for a profit take.
Oh, all right.
So this basically means we're going to have 2 consecutive minutes of the price meeting our profit take before we exit. However, when we do that, we're going to get rid of our exit slippage because
Makes sense.
When we're exiting an order, we're going to have it in exactly at like $1.50 or whatever that is. And since it hits twice, we're going to get rid of that. So you can get rid of exit slippage. We're still going to have stop. Yep. Get rid of that. And then also see how it says cap non-operating profits at target take and stop loss. Do you know what that means?
No, I saw you did that the other day, and I wanted to ask what that meant.
So capping it basically means that, if the market jumps from $3 to $4 and our stop loss was at $3.50, if we don't cap it, it would give us like $4 basically. But since we've worked in 50 cents of stop loss slippage, we're saying even though we may get $1 sometimes and 0 times sometimes, in aggregate, it's probably like 50 cents. So this is probably the best assumption over the long term because we're not, looking at it is. So we're going to hit both of those, and we're doing the same because with the profit take, if it gaps like that, we don't want to get paid more or whatever. So those will be kind of the terms that you'll be using on here. And then just play around that. Hint, something at like 10:15 to 11 would probably be nice because it's inverse of all in it opened. And then also something that doesn't use any VIX filters because, again, we're already using that on all in it open, and that's going to give us diversity. So like if we have something even with a smaller edge that we can make a bunch of occurrences with, and then in addition to that, it doesn't have the same filter, so we're not taking double the risk every single day when all in it opens going, that's probably going to do as a good change of portfolio. So I'll say, do you have any other questions in regards to this?
That makes perfect sense. The last sentence you said honestly opened up a lot of questions I have, but I'll start one by one on it. I think my biggest question when looking at this trade is what is the difference between this trade and a calendar trade? Because it seems pretty similar when it comes to like the filters I'm throwing at it and like how we're placing it. Now, you did make me think of it differently when you said put it at the 10:15 to 11 because we usually put our calendars in at the end of the day because of the theta decay. But this one, what's the difference between this and a calendar?
Scroll up to the top and then change the short leg to 5 days to expiration. Okay, what is this now?
That looks like a calendar, yeah.
Correct. And it's a calendar because why?
I can't remember the strategy, but the strategy is the theta decay.
Right? Yes. So there's 2 aspects. So calendars have different durations. Now change it to 7 days. And vertical spreads have same durations. So that's part one. The next part of it is calendar spreads share the same strike. So can you make a calendar for me? Get rid of the call legs. Exit out of the call legs. You exited out of the put leg, but you can add it.
My bad.
So exit all the calls. Okay. Now, perfect. Okay. So can you make a calendar for me?
Yeah. So let's just do just easy 50 wide. And then I would go here.
Okay, let's take a step back. So when we have the 4 legs, that's a double calendar. So this with 2 legs is, what do you think you would call this if you're just using the put side instead
of a single calendar, right? Just a normal calendar, right?
Yeah. But more specifically, what do you think you would call
it? I honestly don't know.
So this is called a put calendar. Okay.
Put calendar.
But right now, is it a calendar?
No, because of the. Oh, I remember it is. Yep, so that's a calendar.
It is, but in a calendar, we're taking risks. So it's like, what's the problem with this? So
it's very limited on the risk.
You changed the duration, which is the days to expiration, but calendars generally share strikes. So the short put and the long put will have the same strike. So if you wanted to make that, what would you do? So change the long put to 0 because it's going to share the same strike. No.
Oh, I see what you're saying.
So now that you're here, you have no directional risk. Does that kind of make sense?
Yeah, I see what you're saying.
You do as at entrance, you have no directional risk. It obviously changes as the price moves, but this is a calendar. And why is it a calendar?
Well, I see it's a calendar because there's the theta decay here.
So
And
let's go back to theta decay. So what makes it a calendar is we're short one option and we're long another option, but they have the same strike.
yeah,
So the
yeah.
reason it has theta decay. So is this trade going to be a credit or a debit? Are we going to pay to open this trade, or are we going to be compensated with premium for this trade?
See, I'm gonna be honest with you. I get confused with that because I know we're selling it first, so we're getting rid of.
But here's the thing. Now this is kind of like a Greek lesson. Do you remember what Greeks
Yeah.
are? Okay, so
Yeah.
the longer in duration we are, the longer duration option will be more or less valuable if all things are the same, all the same strikes. Will it be more? Will it cost more or less if it's longer in duration?
Well, if it's when we're talking costing, it's going to cost more if it's longer duration.
Okay, exactly. And why does it cost more?
Because we're holding it longer, and I'm trying to think.
We're less likely to know what's going to happen the longer
Yeah.
out we go in time. So if you think about it, if you sign a 30-year mortgage and interest rates drop, you say, wow, this sucks. What are you going to do?
Yep. You're gonna an interest rate drop. You're gonna refi.
Yeah, and then if you have a 30-year mortgage and interest rates skyrocket, what are you going to say?
Hold on to that mortgage.
Exactly, because and the reason we have that flexibility is because it's 30 years out. So this is kind of like that same thing is the longer out in time we go, since the government isn't financing our option trades, the more uncertainty we're going to have. Therefore, the more people are going to be compensated for it. Okay.
Makes sense.
Now, the other flip side to this is what decays faster. Forget about, because like if you pay $1,000 for a 30-day option and $100 for a 0-day option, obviously the absolute amount of decay is not going to be as much on the short option. But what do you think decays faster? And that's the theta component. So what is going to go to the value of 0 faster, a 2-day option or a 10-day option?
2-day option.
And why is that?
Because I'm just spitballing. It's I just know the closer you get to the expiration, the faster it can move to 0. Is it because of the volatility?
Yeah. I mean, the way to think of it is the closer we get to expiration, the more certain we will probably be on what the price could potentially be.
Yeah.
And options are either worth money or they're not. If they're in the money, they're worth money. If they're out of the money, they're not. So you're basically playing, we can call it an uncertainty spread here. So even though you're buying the option on a calendar, so that's kind of counterintuitive. Since we're paying for this option, you would be like, are we short theta or are we long theta? Are we going to get paid from time passing, or are we going to pay other people from time passing?
We're going to pay other people for time passing on this one. If we're out farther.
Not quite, because what decays faster if we have the same strike? So even though we're buying, so like this, and this is the whole theory behind it. So it's like, even though we're buying this option, we're paying more for the options than we sell it. Which one goes to 0 faster?
Dude, the one we're selling is going to go to 0
one,
faster.
Which we're short on. So, but this is kind of counterintuitive. It's like, so we're short theta, even though we paid for this. Okay,
makes sense. Yeah.
Now let's go. Now, can you make a vertical spread for me? A credit sell vertical spread.
A credit spread vertical.
Yeah.
You said you want me to do
are we
premium?
Are we going to collect money, or are we going to pay money for a credit spread?
we're still going to be buying it, correct?
Are we? Credit spread. Why do you think we call it a credit spread?
Oh, credit. I thought you were just
Or a
saying if I were
vertical
just to
spread. We're
change
doing
that.
a credit vertical spread. So if
No,
make,
we're selling it for a credit spread.
yeah. So make a credit vertical spread for me.
So this is considered a debit right here
Why? Because you're
we're
selling.
selling the put and then buying it. All right.
Yeah,
So
so this, what would you do? This is not a vertical spread because there's no, if we look at an option chain, like if that's the 5,000 put, you go down 4,000 put, 3,000 put, so such. So it's called a
yeah.
vertical spread because we need to have different strikes on the vertical. So we need to have different prices basically on the vertical. So if you wanted to make that, so you got the duration right, how would you make that correct?
Oh yeah, because you would have to do like, is this where you do that?
Yeah. And why'd you choose minus?
Because I just know puts always go with minus. I don't know honestly what in my
Does
mind
it on the
triggered
call
it.
side?
Huh?
Does it on the call side?
No, it's always positive
Okay.
on the call.
So make a 0 DT call credit spread for me now.
Um,
Make me a 0. Yeah. Okay. And why'd you do this?
well, you just told me we're not doing the same strike price anymore, so that's why we have to have 50.
Yep.
And we are buying this one. Is that correct? We are buying it when we do the
So
sell.
again, we look at the spread. Let's call 5,000 at the money. So if you sell the at the money call, you need to buy a call above it because if it goes up, we need to be. Whereas if you sell an at the money put, you need to be below it because put, you don't want to go down. Okay. Now, next thing, make me a 21-day short strangle.
All right. This was a 21-day short strangle. All right. So I have to go back to understanding the strangles was selling a call and selling bam and then bam and then um and then bam, but this is not right. So
Okay.
what
So
did we have to do?
you can get rid of that leg. Just get rid of it and then just go add leg.
Yeah. And then sell call at 15.
Okay. Now make a 5-7 double calendar. Double calendar.
5-7 is 5-7 the duration.
Yeah.
All right. And then I'm just gonna start because it's gonna make it easier for me in my mind. And then why can't I just like, oh, I gotta do this. And this is a
Why are you doing that?
Yep. No. Yep. All right. All right. All right. 0. Yep. Then let's just do this. Bam. Bam. And then Adelaide. So call. Adelaide. 5 ball. And then it's 15. And my bad. Do this.
Okay, perfect. So you've now can create all of these. I think the next step is kind of like we need to understand the Greeks with these. So
Yeah.
what causes us to be short theta?
What causes us to be short theta is because we are on the 5. We're closer to duration on this side than we are on this side.
Yeah, the theta decay is faster
Yep.
than the longer duration. So that's
sense.
basically it. Yeah. And then on a vertical spread, what causes us to be short theta?
The vertical spread, what causes us to be short theta, Is it the different strike prices or no?
Yes. So we're
All right.
closer to the money. So on this
All right.
one, the option that is closer in duration to expiration gives us a short theta. On a vertical spread, the strike that gets us closer to duration makes us basically short theta.
All right. That, to be honest with you, I knew none of that. So that's
Yeah.
great. That
Okay.
helps. That explains a lot.
This is good. And my next one here is okay. So we'll do this real quick because we're coming up on time. So go 0 DT iron condor. Make that
All
real
right.
quick.
Yeah. Do you want me to just go to the strategy or make it?
Yeah, you can just click it. Okay, now scroll down and change it to SPX.
Oh yeah.
And then scroll down. You're going to do a one lot. So you go max contracts per trade one. Scroll up. Max contracts per trade one.
Oh yeah.
And then let's just go 1045 for time. And then daily 1046 is fine. Just make sure it's AM. Make sure it's AM. Okay, daily, that's fine. Scroll down. So our 0 DT intermittent stops are good. Scroll down. Commissions and fees are good. Entry slippage is good. Exit slippage is good. Just make sure you check the 2% and 5% for entry and exit. And then you're
Do you
all
want me to go to there?
Well, it's percent of the premium. So you need to know how much you collect. Scroll back up to the top. And then change it to dollars instead of delta.
Yeah.
Fixed. Fixed premium. Perfect.
Let's just do like 2 and 1.
Yep. And then let's go 50 wide. Okay. So your project now, run this real quick. So you'll save this as like next time experiment. So this is kind of the thought is like, let's get something with a profit take and something with, and hint, 1x profit. I mean, stop loss is probably good. Maybe you even get it lower. But do you remember the expected value equation that we talked about?
No, remind me on that.
So it's average win, average loss, win percentage. So in this one, we're going to affix our average win because we have a profit take. We're going to affix our average loss because we have a stop loss. And then we're letting the win percent be the variable. So if you wanted to basically increase your win percent, the way you could do that would be either by increasing your stop loss or decreasing your profit take. Does that make sense?
No, yeah.
So your two levers here are going to be profit take and stop loss. Okay. And if you have a 2x stop loss, which means your wins are twice as big as your losses, you're going to need to win at least 66% of the time. So you can see here, your average win is about twice the size of your loss, or your average loss is about twice the size of your win. So you can see here, we don't make money because we're not at 66%. So your levers that you're going to play with are going to be making the profit target lower to increase the win rate, making the stop loss lower to basically keep the average loss lower, or increasing your stop loss so you win more. So to reiterate this, your win percentage is one variable. Okay. If we increase our profit take, will our win percentage go up or down?
We increase our profit take, our win percentage will go down.
Why would it go down? We need to make less profit to win now.
So I thought, my bad. I'll just explain my thought process. Yeah. I thought you were saying to decrease the profit take and increase the stop loss, right?
So we're going to look at each one individually. So with our profit take, if we decrease the profit take, meaning we need less profit to exit the trade, will we increase or decrease our win percent?
We will increase our 1%.
Okay. And then if we increase or decrease, if we decrease our profit take, will we make on average more money per trade or less money per trade, basically our win size?
We'll make less money, but we'll win more.
Correct. So we need to balance those two vectors out. That's going to be one of the things we do. Now, our next vector is stop loss. If we decrease our stop loss, will we win more or will we win less?
We will probably win less, right?
Correct,
Or
because your stop loss went down. But
yeah,
will our average loss be bigger or smaller?
it will be smaller.
Okay. And then if we increase our stop loss, will it increase or decrease our win percentage?
It'll increase both pretty much, basically. Our win will increase, but our also loss could increase as well, right?
Yes, our average loss will increase. So save this and say like end of year profit take project, and then save it under Connor learn to trade.
Yeah. And I
And then
like
save,
this.
yeah, and then save
Yeah,
it under.
this is,
Yep. So and save it. And then this is just the expected value equation. So keep track of everything you're doing in a spreadsheet. And I would recommend starting with the same premium so you can calculate your entry and exit slippage. And
all
then
right.
basically from there, you can start to play around with what's going on. And we don't want to filter any days out. It's fine if you just do SPX dailies for this, but you're not going to use any filters and you're going to see if you can find something that can make money.
Makes sense. All
Yeah.
right.
Also, hint,
like
closer to the money is probably better because when we're looking at this implied volatility minus realized volatility minus commission slippage and fees, if we're only collecting $3 and we're paying 10 cents of entry slippage, we're already giving up like 4% of our potential profit just from entering the trade.
Mm.
Whereas if we collected $4 and $2, we're now only giving up 2%.
Makes sense.
So it's going to cost us less money to run our business, basically.
That makes perfect sense.
Okay, sweet. I think we will leave off there. And that was pretty good, but we'll see what you have next time when you come back. And then we'll also look at kind of the other trades that have been running.